Markets are navigating a complex landscape shaped by shifting rate expectations, rapid advances in AI, and the evolving role of digital assets. Today, we'll explore key developments across interest rate expectations, equity valuations, and structural changes in capital flows. Let's begin with interest rate expectations and the notable steepening in the US yield curve. While the short end is moving lower, as markets are currently pricing in 5 rate cuts over the next 12 months, the long end is rising, driven by persistent fiscal concerns, heavy treasury issuance, and rising term premia. With front-end yields anchored and offering limited value beyond carry, we now see better opportunities emerging in the belly and long end of the curve, where yields remain elevated. Turning to the investment dynamics within the AI ecosystem, we've recently seen a sharp rise in AI-related corporate deals, reflecting both the magnitude and transformative potential of this ongoing technological shift. This uptick, somewhat troublingly, has raised concerns about circular financing. Companies investing in one another, creating a feedback loop confined to a concentrated ecosystem, which has drawn comparisons to the dot-com era, particularly in terms of systemic concentration risk. Despite these risks, we maintain steadfast in regard to our constructive view on AI as a long-term growth engine. Such conviction is supported by the financial strength of leading AI firms, the scale and strategic rationale behind many of the deals, reasonable valuations relative to growth prospects, and, most importantly, AI's capacity to drive transformation across sectors, geographies, and industries. Building on the AI theme, we now turn to how markets are pricing AI optionality into equities. Oracle's recent earnings offered a clear example. Despite underwhelming cloud revenues, the stock rallied on forward-looking AI expectations. Investors are beginning to assign value to the potential, not just the present, of AI integration. In this environment, given that we're still in the early stages of this transformation, the accelerating pace of progress, and the scale of capital expenditures beyond the tech sector, we believe pricing in AI optionality will soon become critical to equity valuations. Lastly, we'll examine the growing role of stablecoins. Stablecoins are digital assets that are typically pegged to real-world currencies or commodities and enable cash transfers, streamlined remittances, and cross-border corporate transactions. While their utility is clear, the macro implications are far less straightforward. With over $120 billion in circulation and a potential high-end market estimate of $2 trillion, stablecoins represent a growing share of demand for short-term treasuries as their reserves are heavily concentrated in these instruments. Yet, they are not FDIC insured, do not guarantee par value, and their stability under stress remains uncertain. As adoption widens, stablecoins will begin to compete more directly with traditional bank deposits, potentially altering funding dynamics across the banking system. Large financial institutions have taken notice of this, with several global banks exploring or launching their own tokenized deposit products to defend market share and meet evolving client expectations. As this market grows, so too its integration with traditional finance, raising the risk of financial contagion in the event of dislocations or liquidity pressures. Taken together, these developments point to a rapidly evolving investment landscape, one marked by structural shifts in monetary policy, technological innovation, and the digitization of financial infrastructure. The interplay between falling rate expectations, AI-driven equity repricing, and the rise of digital assets is not only reshaping capital allocation, it's also challenging traditional valuation frameworks and funding mechanisms. As investors, staying agile and forward-looking will be essential, not just to navigate volatility, but to identify the opportunities emerging from this new era of transformation.